fourth technique or method we have is internal rate of return. And internal rate of return is the reverse calculation of net present value. Before explaining how, let's quickly recap what we were doing during NPV calculation, and then we will understand how IRR is the reverse procedure. For NPV, we got our investment which we paid today. Then we expected that there is some profit coming in the future. In our example here, we paid or we invested 10,000 US dollar, and we expected this 5 profit cash flows over the next 5 years. Then we reduced each one of these future cash flows to the present value, sum it together, and we sum it to the negative value of our investment, 10,000 US dollar. And the quick reminder, 10,000 US dollar remains the same because it's already today in the present. We don't need to reduce it to the present value, and we put it with negative because this is an expenses or our investment, not a profit. And at the end, we got our NPV equal to 4,382. And we agreed that a positive NPV, meaning we are making profit, negative NPV, that means that losing money. And if you have two NPVs, both of them are positive, then the higher positive value is the more desirable. This is quickly how we calculated NPV. One last thing, how we calculated the present value of each one of these future profits, exactly by using what is known a discount rate. We divided on it, and we got the present value of each one of the profits. And actually, that's what I was building towards, the discount rate. IRR is the value of this discount rate, which will make our NPV equal to 0. Exactly, it's a very valid question. Why? And this is what we are going to understand by using an example. So, but for now, let's remove, this is the equation for NPV. We have this small r, which represent the discount rate. IRR is going to be NPV equal 0, and we replaced the small r with IRR, or internal rate of return. From the formula, you can expect that this cannot solve it straightforward by applying numbers. This can be solved either trial and error, or using a hard-coded formula in your calculator, or using Excel sheet. Our example: a project with initial investment 200K and lifetime of 4 years, which is expected to get your business a profit of 50,000 US dollar in the first year, and the growth by 25,000 for each of the next 3 years. What we are going to do right now, for me, I'm going to use an Excel sheet. Of course, here we are asking what is the IRR for this project. As I said, I'm going to use the Excel sheet. Calculation sheet is attached, and I will now switch to the Excel sheet. So our initial investment here is the 200K, and I put it as a negative, and year 1 profit is 50, and then 25K growth each year, meaning second year going to be 75, third year 100K, year 4 is going to be 125. Actually, calculating IRR is pretty simple. It's a hard-coded formula that says IRR, and all you have to do is combine all of them. Please don't forget the sign, and negative is very important to be added. Press enter. Is 22.7%. We still didn't answer what is the meaning of all of that. Don't worry, just keep up with me. Back to our course. So this is 2020. We get 22.7%, or let's say 23% of IRR. What this value means for us. It means that IRR is considered an indication for a growth that a given project is expected to generate along of its lifetime. With alternate opportunities, the opportunity with higher IRR is more likely to be selected because it promises a higher level or a higher growth rate. That's why RRR is commonly used to compare profitability between establishing a new operation or extending a current one. How is that? For example, you may face the situation of building a new warehouse in different location or extending the existing one to have a bigger warehouse, or building a new power station, or re-innovate the existing one and increase its capacity. Each set of this alternative, both of them, we know that they are profitable, and we know that both of them are going to be an addition for our business and it's going to provide a growth. But which one we go for? Here comes the rule of internal rate of return, or IRR, to give us an indication which alternative giving you a better or more growth rate to go for. And as agreed, the higher growth rate is the one you should go for it. Remaining one note I would like to discuss, there is a term you may hear around called required rate of return, or triple R, and this is used by the investors to determine the minimum acceptable return percentage of an opportunity. So investors sit down, evaluate an opportunity, and they decide, okay, minimum accepted return percentage is 10%, for example. Less than that, this opportunity is rejected by us. And in this case, IRR is commonly used along with the triple R, that if the IRR more than the triple R, then it's a good indication. So if the investor says like we cannot accept less than 10% triple R, or required rate of return, and after the calculation of IRR you find like it's 12% or something, meaning that it's a good thing. You can go for this project.